Hello there everyone, today's video is all about the change in the taxation for sole traders and partnership. Specifically the timing of when tax is taken on partners and sole traders. So what we actually mean is a change in the basis period. Basis period, which is just tax jargon for the period of which you are taxed. So why is it changing? Principally it's changing to accelerate the point at which HMRC are going to get some tax from sole traders or partnerships, because of the fact that partnerships and sole traders can choose what their year end is. They decide on a business year end and they are taxed for a period in a certain tax year based on the year end that ends in that year, not the 12 months to the end of 5th of April or 31st of March. It's all about their accounting year that ends in a tax year. And HMRC are looking to change that from 2023 to say we want tax for the 12 months ending on the 31st of March, because it accelerates the payments, the receipts into the Treasury's coffers. How exactly does it do that? Well, let me show you. So let's take an example of a partner in a partnership who earns £120,000 a year profit share. Keep the maths easy, 10 grand a month. Partnership has a year end of 30th of April. Now, a lot of partnerships historically were set up with 30th of April year ends. Because of what we call the opening rules under self-assessment, it means that it delays the point at which you pay tax. So there are thousands and thousands of partnerships with 30th of April year ends. Hence, that's why I've chosen this example. Partnership is a 30th of April year end. What about the year ended April 30th, year ended 30th of April 2022? Well, the business year end ending on the 30th of April 2022 falls just inside the 2022-23 tax year. Yeah, April the 30th, 2022 is in the 22-23 tax year. It's about 3 weeks in. But you are taxed for that 22-23 tax year on your profits for that year, means that you are still earning, obviously, between the 30th of April 2022 and the 5th of March 2023, which is still in the 22-23 tax year, but you won't pay tax on those profits until the following tax year. And this is what HMRC is looking to address and say, we're getting our money too late because of situations like this. So let's take this example. Same guy, 10 grand a month profit, 120 grand profit share, year ended 30th of the 4th, 2022. Now, what happens is when you become a partner or become a sole trader and you set your year end at any month other than March, you will have what's called overlap profit. And that is when you've effectively paid tax twice on the same amount of profit. It happens in every sole trader business, every partnership where the business year end is not aligned to the tax year end. And that overlap profit gets carried forward indefinitely, often for years or decades, and then it's relieved when you retire or you change your year end. So in this case, let's say that this guy's got £70,000 overlap profit. So that is the amount of profit that he paid tax on twice when he became a partner. Now, typically in partnerships, over time, let's say partners earn more. He came in as a junior partner, was on 80 or so grand a year, and now he's on 120. So the overlap profit that he's accrued is the 11 months from the 5th of April to the following year. So in this case, let's say it's 70 grand. Okay, so that's the current situation, 120 grand a year. He's got this overlap profit that he's paid tax twice on 10 years ago of 70,000, but he will pay tax in the 22-23 tax year for the year ended 30th of April 2022. So what are the changes? Changes are this. The proposals, HMRC is saying, right, from the 22-23 tax year, same example in this case, for the year ended, the business year ended 30th of April 2022, HMRC want to tax this individual on his earnings up to 31st of March 2023. In other words, for the entire tax year. So they want to change how they tax. So this is the transition year where you go from being taxed on 12 months for the year that ends in the tax year to the full amount in the tax year. So in this case, 23 months. 23 months he will be taxed on this. 12 months for the year of the 30th of April plus 11 months to the 31st of March 2023. That's 23 months worth of tax. However, like I said, there is this overlap profit available to be relieved, which was the point when he was taxed twice on the same slice of profit when he became a partner many, many years ago. So in the calculation, in 2 years' time when this comes in, taxed on 120 grand for the year ended 30th of April 2022, plus 11 months worth up to the end of the tax year, assume the same run rate, 10 grand a month, that's 230 grand, less the 70,000 overlap profit, which is accrued from when he became a partner. That's still a taxable profit for that period, for that tax year, of 160,000. Whereas under the existing rules, it's 120. So in this 22-23 tax year, he will be subject to tax on £160,000 rather than £120,000. And that's the reason that HMRC are doing this, is to get the money sooner, because it's all about this period here where the tax that you pay on that, in this case 11 months, is deferred another year based on the choice of the accounting year end. And that's the anomaly, if you will, that HMRC is looking to address. Everyone's just playing by the rules doing this. That's the rules that HMRC brought in when the self-assessment came in a quarter of a century ago. But now they've taken another look at it and said, aha, there's an issue here. We're not getting paid tax soon enough. So in this case, thankfully, these proposals, by the way, that have just been announced, they're not fully in law yet, but they may not change too much from the draft proposals. But thankfully, HMRC said, look, we understand in situations like this, that could be a big deal from a cash flow point of view for partnerships and businesses. If you're going to be taxed on an extra 40,000 and you are a 40% taxpayer, that's the best part of, what's that, about 17, 18 grand of actual extra tax in the year. So what they are proposing is to let you spread that one-off catch-up, if you will, over so many years, which would be good. That's obviously a fair thing for them to do, because obviously, can you imagine you've got partnerships, firms of lawyers, accountants, multinational law firms with thousands of partners. This figure, the extra tax, could run into millions and millions of pounds. So the proposal is that it's going to be, you're allowed to pay the catch-up amount over several years. And then, of course, every year, you're on the cycle of being taxed to the end of the tax year. The fiscal year, not your accounting year end. So a big deal there, a big deal. Like I said, it applies for partners and sole traders. Totally different ballgame if you've got a limited company and you pay yourself salary, dividend. That's not going to be affected. This is all about the basis period, what we call the period of which tax is paid on if you are a sole trader or a partner. So do consider this if you're in that situation, especially if you do not have a March 31st year end. If you've got a March 31st year end, nothing's going to change, because that is the year end of the fiscal year anyway. It's only for those self-employed people, partners, self-employed, sole traders who do not have a 31st of March year end. So that's just an overview there on HMRC's recent proposals, all about getting money in quicker on profits earned by the self-employed. If you like this video, please do subscribe. Just about there, and as always, I will see you soon.